Good morning, everybody. Welcome into the Mining Stock Daily long form episode this week as we work towards ending the month of July, and it has been an incredibly volatile last couple days, not only in big markets, but also in the precious metals sector and the base metals sector. And we're going to ask, there's a lot of themes that have been tossed around here in the last week or two, including rotation and what it means for small caps. So I welcome back into the podcast Barry Knapp from Ironsides Economics for a little bit of some thought analysis on what he's witnessing in markets. We discuss the volatility in the markets on the back of U.S. politics and the upcoming election. We do talk about the rotation, and we also discuss about the possibility of a Federal Reserve rate cut. Does that happen in September? Does it happen sooner? He's got some pretty interesting perspectives to share with us regarding the Fed rate cut cycle and what might happen with markets on the back of that. Does it awaken animal spirits once again? Special thank you to Arizona Sonoran Copper, Fireweed Metals, and Visa Silver for their continued support of the podcast. Visa put out an excellent PEA for the Panuco Kapala project this week, and might add is go catch that interview I had with CEO Mike Connor. All right, let's jump into this one. It's an important conversation with Ironsides Economics' Barry Knapp. Have a great listen. Have a wonderful weekend. Be well. Last week, we were talking to Julian Brigden over Beaver Creek and Bachelor's Gulch, so we're going to move a little bit east into the Vail Valley. So a lovely time of year to be in the summit in the mountains of Colorado.
Yep. It is beautiful.
It is beautiful. Obviously very peaceful. Listen, I wanted to take as much time as I can and talk to you about the volatility we're seeing in markets on the back of U.S. politics and really this kind of wading into waters. Like, it seems like every election cycle we're talking about uncharted waters. We do it every dang 4 years, it seems like, Barry. This has kind of some ramifications. Last week we were talking about a quote-unquote Trump trade as his polling numbers were skyrocketing after that debate. You could see the rotation happening in real time in 3 or 4 days of market participations out of growth into small caps. And then lo and behold, here we have a rotation in politics. It's obviously Biden is not going to be that front runner on the ticket. We are meant to believe that Kamala Harris is to be the front runner, and I guess that all would probably play true if the election were tomorrow. But there's a little bit, those odds of a Trump being the favorite has those margins have decreased mightily, and the markets are just kind of trying to come to grips with all this. I mean, as you're watching this the last couple days, how are you? Have things changed since you kind of wrote your weekend note that you published on Monday?
So I'm going to start by pushing back on the idea that Trump's surge in the polls post the debate and the now reversal of all this has had much to do with what's happened in the markets. First of all, on the vicious short covering rally in the small cap index and the Russell 2000, I think it had virtually nothing to do with the so-called Trump trade. It had everything to do with monetary policy and the weakening economic outlook. So, as a reformed equity strategist, it's been long part of my, my area of so-called expertise, right? And what you've found historically is that small caps rally very sharply at the beginning of a business cycle. They also rally sharply when you're coming out of what I've named Fed policy normalization related corrections. So every business cycle, we have a point when the economy reaches escape velocity, as Mohammed El-Arian would describe it. The Fed starts tightening and you get roughly a 10% equity market correction. Small caps go down more than 10%, just the beta effect and the impact of tighter policy. They rally more than the S&P coming out of a recession, but they go down more than the S&P during a recession, right? And this is a more volatile, vulnerable, cyclical sector. So it really is not a sector per se, it's capitalization, but this is an early stage cyclical sector. They have not gone down outright over the last 6 months. They've underperformed. So this for me is a reason why I think this was a very temporary phenomenon. But when we got to the point following the June CPI that it became clear that the Fed was going to start cutting rates in September, then small caps had a vicious rally because, and quite frankly, a lot of clients agreed with the view that I've had through the course of the year, which is you should be underweight small caps or short small caps, short small banks. And the fundamental reason behind that is the deeply inverted yield curve, the very tight monetary policy, if you're a floating rate borrower, was impacting small companies and small banks in particular. And small companies tend to finance at floating rates, and they tend to finance using the banking system. So these are the main factors that were pressuring or causing this underperformance of small caps. But because they never went down outright, this was never really likely to be a persistent trade. So the thing that triggered the small cap rally, and remember, we just had the Russell 2000 rebalance as well. And so with that rebalance done, that and the CPI number and the weaker economic data, we could talk about the Fed, is the real catalyst behind that small cap outperformance. It has nothing to do with the inflationary implications, or I would describe them as deflationary implications of Trump's trade policy, tax policy. That's not what drove this rally. I've heard people say that on television, but it's just not the case in my view. It's more to do with the Fed. And so, when you think about the broader elements of the Trump trade, typically elections can be picked up in sectors more than they can get picked up in the broad economic outlook. I am sympathetic to the idea that a Trump administration, at least until and unless he demonstrates a willingness to cut government spending from 24% of GDP to 20% of GDP, it should put some pressure on the back end of the Treasury market. It could put some downward pressure on, dollar yen, dollar RMB, dollar euro. But as I put in my note this week, negotiating another Smithsonian agreement like we did in 1971 when we were, upset about finally starting to run trade deficits after, several decades of surplus following World War II, or Plaza Accord when the same problems arose. It's going to be very difficult. But tariff actions themselves, were Trump, for example, to put a 10% tariff on global products, that would likely cause the dollar to go up by 10%. That's what happened when he slapped a 10% tariff on China, on Chinese imports. The RMB went down 10% and more than offset the tariff. So, those are sort of longer term maybes, right? So, but I am sympathetic to the idea that as we get closer to an election, if it were to look like Trump was going to win, then that could put some pressure on the margin on the back end of the Treasury market. That could be a bit of a bear steepener. It could put some pressure on the dollar. It would be generally good for financial sectors. You would get a lighter regulatory touch, probably good for the energy sector, though maybe not the price of oil itself, more the infrastructure type plays. But I think we're headed towards a lighter regulatory regime because of the Chevron deference decision anyway. For example, it's not really clear that the regulators have the right without congressional action to adopt Basel III endgame rules. The banks could probably sue and have some degree of success. So anyway, a lot of that political stuff, I think, is kind of muddled. I know it's gotten a lot of interest, but my assertion right here is that the outlook for monetary policy is a much bigger deal than the election. And I get we've just gone through, the three most tumultuous weeks in politics in my, 62 years on the face of this earth. I guess 68 was pretty wild too, but I was 6 years old. So, I don't recall it, and I do vaguely recall Nixon resigning on TV. My parents had me watching it with them, but, this was pretty tumultuous stuff. But I don't think it's as big a deal for the markets as the growth outlook deteriorating and labor market in particular, and there's some really important stuff going on there, and what it means for Fed policy. And that, I think, is a bigger deal, near-term deal for the markets right now. And, back to my evidence of that, the small cap short covering rally was really all about monetary policy, not about potential public policy resulting from an election.
Maybe we come back to potential economic policies from administrations to come, whether it's Trump or whoever the Democratic Party might be. Like I said today, would be a Harris policy. I don't know if a Harris economic policy changes much from what we've had the last 4 years with Biden. Obviously, if Trump were to come into office, a lot of things would change, that Trump 2.0. But let's table that, because let's talk about monetary policy, the Fed. There's a price, a rate cut is priced in for September. It seems like you've kind of been out there on the board saying that it has to happen. It's overdue.
Right.
So maybe let's just open that up for a little bit. You've been through rate cutting cycles before. You've seen the first rate cuts after tightening cycles throughout your career. What does that playbook look like? Is this time any different than previous reversions to cycles?
Well, the best analog to this cycle is the 94 and 95 cycle. And there's lots of similarities, even from a broader investment tech perspective, broad capital investment perspective, economic conditions. The big difference, though, is we were in the second decade of a 4-decade disinflationary trend. And now I would argue we're in the first decade of a more inflationary trend. But that notwithstanding, the Fed tightened from 3% to 6%. CPI remained roughly unchanged at 3% during that period. So we had a 3% real policy rate after the end of a year-long aggressive tightening cycle. Well, we now have, assuming we get a 2.4 print on headline PCE inflation, or the PCED, on Friday, we have a 3% real policy rate. The difference between this one and that one is the Fed's balance sheet and how they conducted this tightening policy, which led to the deepest yield curve inversion since the Volcker era. And that deep yield curve inversion is at the core of why I'm negative small caps and small banks, and have been all year, and think that the Fed needs to cut the policy rate to 4%. And
Wow.
The sooner we get there, the better. So they'll have to do a little bit more than they did. They cut twice. They cut 50 basis points after that 3% rate hike in 90 from Feb of 94 to Feb of 95. They tweaked the rate twice later in the year. I'm arguing they need to do a bit more than that this time because of the curve inversion and the need to disinvert it. And again, just some background on that. When the Fed hiked through 3% in September of 22, that's when the Fed's portfolio started losing money. Well, the banking system has about a third, or had about a third, of their assets in treasuries and mortgages at that time. And their portfolio looks just like the Fed because they bought them all, most of them in 20 and 21. And so they started losing money on those portfolios at the same time. And then, of course, shortly thereafter, we had Silicon Valley Bank go under, and First Republic Bank essentially go under as well, although their assets were fixed rate, but they were mostly mortgages, and whole loan mortgages, not treasury securities. But so there's something called R double star, the financial instability rate. When we went through 3%, the Fed started losing money. We hit that financial instability rate, and you could see that permeate across asset classes. The yen crashed, Japanese needed to intervene, the pound sterling flash crashed, the gilt market came unglued, our mortgage market went bidless on that Monday following that September FOMC meeting, when the Fed hiked 75 for the third time and raised their estimate of the terminal rate by 80 basis points. And that was the financial instability rate. Over time, the financial instability rate goes up, and I think it's roughly 4%. And it goes up because the treasuries that Bank of America and everybody else bought back in 20 and 21, if they were 5-year treasuries then, they're down to 1 year or 2 year treasuries today. And so those are starting to run off their balance sheet. So they have a little bit more room. But that deeply inverted yield curve, you could see it in bank earnings, net interest income is falling sharply because their deposit costs have finally caught up with the money they're making on overnight reserves and, the floating rate asset yields that they get. So now we're in this spot where the banking system is really struggling and it's choking off credit to small builders, small businesses in general. And that's really the key issue here. So how that relates to the labor market and why I think the Fed is going to wind up at a minimum cutting at every meeting for the rest of the year, not including next week's, starting in September, is because we've watched decent payroll gains every month. And the unemployment rate go from 3.4 a year ago to a little more than a year ago to 4.1 today. So we've described it as the tale of two surveys, right? Which is correct. Well, roughly half of the gains in those monthly payroll numbers are coming from the birth death model, which is the way the BLS estimates small business employment. They take the number of companies, new companies being formed. They don't really know how many businesses are dying until at least 3 quarters later. And then they start getting a feel for whether that model is overstating or understating growth. Well, a couple of important pieces of evidence around that. One is we had negative revisions to headline payroll numbers 11 of 12 months last year and 4 of 6 so far this year. So that's one piece of evidence. The second piece is every month they estimate that employment number, the payroll number from a survey of 119,000 businesses. Over time, they go through, and this data is lagged, they go through what's known as the quarterly census for employment and wages. And that's where they go through 13 million company records submitted to the IRS. Right now, we have data through the end of last year. 2 days before Jackson Hole, we will get the preliminary estimate of the annual benchmark revision, which won't be finalized till next February. However, based on that QCEW, easy for me to say, it looks as if they will have overestimated job growth in the year ended March of this year, 24, by 1 million jobs. So that will tip the scales to that unemployment rate. Right, 1 million. So a little less than roughly 40% slower growth. And that will raise a lot of alarm bells within the Fed for a couple of reasons. One is when you look at the Fed, I've called them the evil twin curves, the models by which they think about the labor market. There's 2 of them. One is known as the Beveridge curve, which relates job openings or vacancies to unemployment. And the other one relates wages. It's the Phillips curve to unemployment. Both of those have come straight down, meaning we didn't have real increases in unemployment as wage growth slowed and as job openings diminished. But we're right at that inflection point where any further weakening of demand would lead to a nonlinear or really fast increase in unemployment. And that's how the SOM rule works, which is, you take the 3-month moving average or 3-month average of the unemployment rate, and once it goes up 0.5%, that's a very strong recession signal, and it tends to go up really rapidly from that point. And so Waller, who I think is the most influential economist at the board down in DC, and maybe the most influential economist on the entire FOMC, described the labor market, and I forgot the exact words, but as basically in a dangerous or very risky spot. And this is why. Because if it turns out, remember the Fed's forecast in June was that the unemployment rate would end at 4 at the end of the year. And they've said any unexpected increase, weakening of the labor market would require action. We're at 4.1. That number came out after the summary of economic projections from the June meeting. Even printing 4.1 again next month, let alone going to 4.2 or higher, would be unexpected. And that would get the Fed to react. So if that annual benchmark revision does look like 1 million fewer jobs were created in the year ended March, and the unemployment rate ticks up anymore, it would not shock me if the Fed didn't start with a 50 in September. They probably won't want to do that, But
Yeah.
if we have significant weakness in the labor market, and it turns out they've been wrong about how strong the labor market was, right? Because they love saying it's really strong, right? But it's more in balance. Well, it turns out if it wasn't all that strong, which I think it wasn't, because the small business sector and this birth death model on how they estimate it, just by all accounts should be weaker, because small businesses finance themselves with floating rates, and they've gotten both the cost of credit and the supply of credit. Cost has gone up a lot and the supply has gone down because small banks are having trouble making loans. And you can see that in commercial and industrial loans in small banks. And so I think that the Fed is going to wind up having to cut aggressively. Now, that's a bit of a game changer.
Right.
So right now the market thinks the Fed will get to 4% by mid-year next year. I think they need to get there by the first quarter is my expectations.
So that would be a percentage and a quarter from where we're at now, roughly. Is
Correct.
that correct?
And so I think they'll wind up going at every meeting.
Wow.
What
does that do to animal spirits here, Barry? I mean, people are, I think the market has, we saw new all-time highs on the back of expected rate cut happening, but that was weeks ago. But does this kind of spur animal spirits back in the game? Everybody's long. Numbers only go up, Barry.
I don't think so. No, and I think the earnings story is going to be weak this quarter. We're getting industrial sector earnings this week. I know all the oxygen's going to be taken up by Google's numbers and Tesla's numbers. But the real issue here is that earnings growth in the first quarter was 8% for the S&P. However, ex-tech and communication services, it was negative 0.5%. This quarter, we're supposed to get 10.5% earnings growth, with ex-tech and comm services at 7.5%, roughly. I think those numbers are likely to be disappointing. UPS might be a good example today or not. It's always tricky to pick out one company, but seems like a pretty good company to use as a gauge of underlying economic activity. When we get Thursday's GDP number, if real final sales to private domestic purchasers, which removes inventory, trade effects, that number had been solidly around 3% for most of last year, was looking like it was going to be almost 3% or 3% when we got the advanced estimate for first quarter GDP. It got revised down twice to 2.6. I think there's a chance that number is below 2. So now you're down to a nominal growth level, which would imply something like 4% sales growth for the S&P 500. So a lot of companies that are going to struggle with nominal growth that low because of high fixed costs, industrial sector, energy sector companies, things like that. And so I think the underlying tone, ex-tech and comm services, is going to be kind of soft. And I doubt we get from here to September and then get a cut in September, particularly, if they go 50, they could actually panic the markets a little bit that they know something we don't know. And if they go 25, people might say, hey, they're moving too slowly. So I doubt very much we get through vol season, September, October, without people saying, hey, the Fed's starting to cut and sounding like they need to get going. And this is because, they've been tight for a very long time, and the long and variable lags are finally kicking in. So I don't see this as just kicking off animal spirits. I actually see it as causing a fairly significant growth scare. Now, I don't think we have the kind of imbalances in the economy to tip us into a recession right now. So I would think it would be 10%, maybe a little bit more. It could be a little bit more because of the fact that we're already up 15 or so percent this year. And if you start getting worried about tech and whether valuations in Gen AI really justify it, and whether some of the CapEx isn't being thrown away, all that sort of stuff, it could be a little deeper than that. But I don't think it's a 20%er that you'd typically get, or slightly more than that with a recession. Because again, I don't think the imbalances in the economy exist. I think we just have a lot of pressure on the small business sector, on the banking sector, the deeply inverted yield curve. And I think a lot of it could be resolved with the Fed getting back to 4% in a reasonable time frame. But
But
again, my expectation would be the first reaction to this would not be, woohoo, let's just buy everything.
right.
I think more likely we'll get the old, hey, treasuries go up when stocks go down, kind of, we're worried about growth, which was so evident in the early stages of the post-global financial crisis environment, right? We had a growth scare in 10, a growth scare in 11, growth scare in 12. That's what I would look for.
I'm glad you mentioned that because, actually, I was thinking the timing of all this and where we're at the late summer going into the fall of 2024. It seems like, and I wasn't really participating in markets back in 2008, but we did have an election that year between McCain and what would be Obama, and we also had an that's when the great financial crisis really kicked off and hit everybody in the face. So, there's some similarities here with kind of where we're at.
As a former Lehman Brothers managing director, it was more like a 2x4 across that bridge in the nose. But anyway, just to tighten up the analogy.
Yeah. Hopefully that doesn't happen to you again this September, Perry. But you'll be a little bit into more independent lessons learned. But let's talk about, where you go. I mean, last week we talked about the volatility. We're in, this later part of the summer into the fall, more as a high volatile time of year. We talked about that with our friend Julian Brigden just last week, actually. And he was kind of pounding on the table about how much weight is specific stocks in the tech sector and the growth sector, that Mag 7, which maybe you could argue is maybe the Mag 2 or 3 right now, but especially with NVIDIA. If this thing goes, if valuations and financials truly are going to matter this go round, what is your risk factor with something like NVIDIA having bad earnings and allowing this market to have a decent correction on the back of that?
I don't think NVIDIA is going to have bad earnings, and I don't think Microsoft's going to have bad earnings either. I mean, we know that the hyperscalers, Google, Microsoft, Amazon, they're all spending, $200 billion on Gen AI technology. We've got to build out the energy infrastructure. All these things are going to happen. And this is why I think 95 is a better analog than looking at, the end of the cycle in 99 or 08. This is a real serious phenomenon. And energy might be the best play around it. I was actually one of the people I played golf with last week was the CEO of an energy company, mostly natural gas. And, we were talking about the Gen AI demands for energy there's these companies are liquid. The trends are real. There's not the imbalances in the economy. Valuations are rich, but when the rate of change of earnings growth is going up, it's a considerable dynamic. I had lunch the last time I was end of May. So that wasn't the last time I was in New York, second to last time anyway. I had lunch with my friend Dan Ives, who everyone knows, right? He's a big cheerleader for all this and lives in the town I used to live in. And I know Dan quite well. And I said, okay, well, a lot of customers at that time, clients were asking me, were the comps going to start getting tough in the tech sector in the second half of the year? And he said the comps for NVIDIA were going to start getting tough in the second half of 2025. So, but for Microsoft monetizing, Copilot and all this stuff, there's scent of a woman, right? I'm just getting started. So this is just so early in this phenomenon that I don't see that as a vulnerability. Now, in a growth-related sell-off, could you have a highly correlated correction where everything goes down? Yes. But is the catalyst for that going to be weak tech earnings? That seems highly improbable to me. More likely, as I'm asserting, that weakness will come from the broader economy, the parts of the economy that are vulnerable to the tight monetary policy, a 300 basis point real policy rate, companies that finance at floating rates that are being choked by the lack of bank credit availability, because of the inverted yield curve, that's where we're likely to see weakness. And, then the Fed has a chance to fix it, right? Because they can cut the policy rate and get back. Now, what will that mean for inflation in the longer run? That's sort of a different discussion. Part of what's happened with inflation is the standard deviation of that has come down sharply. Personally, I don't think the level matters nearly as much as the Fed thinks it does. We had an absolute capital spending boom in the 60s with, at least for the first part of the 60s, very low trend inflation, but that standard deviation, that volatility of it was very low. In the 90s, we had, again, very low volatility of inflation, but with higher trend inflation, way above what the Fed currently considers to be the target, 3+. I actually see the 2s10s break-even curve going up. And so I think the best news on inflation is behind us, and it will start drifting up again, mostly because of fiscal policy. But the Fed really shouldn't care if we're 2.5% on core PCED and 3% on CPI, as long as it's stable. If the labor market is weakening, that's what they'll focus on. Remember what the Fed is comprised of, which is a bunch of bleeding heart professors, basically.
Right.
Not to be pejorative, but, look at the makeup of the Fed. It's not a bunch of Austrian, Friedman acolytes. It's, new Keynesians who are going to get really worried about the employment part of their mandate. And they should be cutting. As I said, they did this whole tightening cycle all wrong. Most of the easing was through their balance sheet. Most of their tightening was through rate policy. That's what caused this deep curve inversion. And by the way, for everyone who's saying, well, look at 2s10s, it's only 28 basis points inverted or something, it's coming back. The curve that really matters for the banking system is the 3-month bill against a 10-year treasury or some other benchmark, 7-year treasury, whichever one you want to use, roughly equivalent to their asset duration. That's inverted by 108 basis points. That is the deepest inversion we've had since Volcker, and we've only had a couple of these. We had one in 73, and we had one 79.80, and the 79.81 destroyed the savings and loan or thrift industry, which at the time was 80% of the supply of mortgage credit. So, I heard a pretty credible source. I'm trying to recall who it was. Oh, it's Bob Diamond, my old CEO from Barclays after the Lehman bankruptcy. Bob's got a business sort of based on this, but he thinks the number of banks in this country will be cut in half in a fairly short period of time.
Through bankruptcies or just through regulations?
Mergers and
mergers.
Forced mergers, but some failures as well. But
you mean failing banks and then the regulators and the Fed coming in and forcing their hand?
Yeah, and then how many can you buy, J.P. Morgan? Hopefully it won't be J.P. Morgan buying them. It'll be a bunch of regional guys buying them, and so we won't have the big bank oligopoly we have right now. But anyway. Is that a bad
thing, Barry? Is that a bad thing? I mean, our neighbors up north in Canada, they only have like 4 or 5 banks, so they're huge.
It's not exactly a dynamic economy either.
No,
but that may have more to do with public policy. I think it is a bad thing. Here's my real issue with this, and I had a recent discussion with a Bloomberg reporter about it at length. We were talking about independent research, and my assertion was when the investment banking model died in September of 2008, when we went under, Merrill got sold, Morgan Stanley and Goldman Sachs took our idea and became bank holding companies and started raising deposits. Bear Stearns was gone. Those 5 investment banks were profitable. They drove research. They drove innovation in the capital markets. And that was what drove a lot of the entire industry. Well, now those tightly regulated oligopoly type banks are essentially forcing a ton of capital markets activity to Citadel, outside of the banking system altogether. Now, it never really belonged in the banking system, right? It was the investment banking model. But that model, other than Jefferies and a few other odd places, is in essence dead. And so I do think that part of it is a bad thing.
What about the shadow banks? I mean, there's been so much money printed in the number of last 30 years that all of a sudden these institutions have propped up in the shadow system. What happens to those?
Well, right. So that's what's happening in essence.
Yeah.
The Citadels in all the world, Virtus,
All right. Yeah.
have taken the capital markets activity, and the PE firms are taking the banking activity. And, JP Morgan's doing okay. Goldman Sachs has a 9 and change ROE. That's not high enough, right? I mean, an investment bank, you got to be at least 15, 17% ROE. It's supposed to be a business that takes risk. And with that risk, you have the money to invest in things like research and innovation in other product areas and so on and so forth. Take an area like home equity. Well, home equity lines of credit have just been getting crushed. So what's the solution now? Freddie Mac's, pilot program to be able to get into the second lien market and tack them on top of first liens and solve the first lien, second lien priority problem. And so it's all going to be government lending. That doesn't resonate with me. I would so much rather see, private capital come into that and drive it. And you're right. I mean, you make a good point, right? Some of that is already happening, right? Mm-hmm. PE firms have the old investment bankers. Steve Schwartzman was a Lehman Brothers banker, I mean, that's where these guys came from. So we have pushed it out. So it's not, maybe the investment banking model isn't completely dead. It just has gotten moved into other parts of the economy. But, for me, having 4 big banks just strikes me as not likely to drive innovation and really be a contributor to a dynamic economy.
Mm-hmm. Barry, got just a couple of minutes left. I do want to ask you if this rotation maybe was short-lived. Looking back at this, what do you need to see to be reaffirmed about a real rotation out of growth into value? I mean, even the Dow was having a nice run here not too long ago. It made new all-time highs. It was outperforming, in the industrialized equities on the back of commodities. When does that kind of start hitting your radar again?
Well, first of all, just full disclosure, I am overweight the industrial sector, energy sector, materials sector. Materials sector is de minimis, but that notwithstanding, I do think those are the secular trends. And, energy companies higher ROIC because the elasticity of supply from shale is so much greater than it was when they were drilling in the Gulf of Mexico. I mean, there's lots of, the industrial sector, the manufacturing renaissance, rebuilding of our capital structure, or, manufacturing base, all those are good secular trends. But to buy small caps, to buy small banks, for me, requires a growth scare related correction and then a Fed reaction. So down 10% for the S&P with the Russell going down 14 or 15. And in the couple of months leading up to that September meeting or month and a half or period slightly after that would be an opportunity to then buy value. Right now, it's cheap. It's okay. Maybe we just slide into a Fed easing cycle and that gets us to the right spot. But without that correction, without that growth scare, the Fed probably won't move fast enough to make the broadening trade work, right? And, as I said earlier, the Russell is a great trade. I was all in on it from the lows in 2020. Again, after we had that correction, the 27% correction when the Fed was tightening so aggressively in 2022 and the Treasury was draining liquidity out of the system, again, I bought the Russell in October, but you buy it for 6 months in those cycles when you get a fat pitch, and it's a great trade. There's no fat pitch right now. It's been underperforming, but it hasn't gone down, right? It needs to go down, when people are truly concerned about growth to make, I'm using Russell as a euphemism, but, banks, small caps, value versus growth, that stuff works when you get those either Fed policy related corrections, serious growth scares, or recessions.
All right. Barry Knapp, Ironsides Macro at his Substack there. You can find it at ironsidesmacro.substack.com. Highly recommend, even if just listening to the free stuff, reading the free stuff. Highly informative. Barry, last question, unrelated to markets. Who's going to be the U.S. men's national team coach next?
That is a good one.
Question. That's the hardest question yet.
It is, and all I could say is I'm glad that Berhalter is no longer the coach.
Me both
for sure. Mauricio Pochettino, God, I didn't like him as the Chelsea coach. I didn't care that he was the Spurs coach because I don't care about Spurs, but that would be a terrible call. It's like England's got the same discussion, right? And some of the same names are getting thrown around. Potter,
right.
No way. Pochettino, no way. Klopp would be awesome. I don't think we could get him. England maybe can.
He already told us no. It sounds like he said no.
I would guess, yeah. So I don't know. I mean, Curtis at Philly is a good. He's a good young coach, good young American coach. There's a few around. It's the Columbus coach. I think is pretty good. I don't know. It's a good question. I mean, I like Jesse Marsh too, but
he's not leaving Canada. He's got a good thing going
Canadians have him. Why would he? Because he got treated like shit. And I don't think we have the right. I don't think we have the right personnel up through our organization either.
It's a glorified marketing department in my mind.
I don't know how we put a Welsh guy in charge. It's like all the English soccer coaches we used to hire out in New Jersey have an English accent. You must know more than us, Like I did that with my daughter's team where I was the parent coach and we had a hired English coach. And guess who did the demonstrations of all the technical aspects? Not him.
You.
He knew. I played against him many. It was like, no, this guy's a better player. Coach Knapp's going to show you how to strike a corner kick or take a penalty kick or whatever. But anyway.
Well, I'm sure when something gets announced, you and I will be sending messages back and forth with yays or nays. But okay, Barry Knapp, thanks so much.
That was a loaded question for me. So.
All right. Have yourself a great rest of your day, Barry. Thanks so much.
All right, Trevor. Awesome. Thanks.